Welcome back to another edition of Tariff Talk. I'm Nathan Gotsch, and I'm here with Dr. Michael Hicks from Ball State. Dr. Hicks, I want to start with this. There is a famous example of an economist named Milton Friedman, and he holds up a pencil just like this one, and he uses that as an example of why trade is so important to our economy. Can you talk about how these tariffs would impact the manufacture and then the cost of something as simple as a pencil?
Right, that's a great question. I'll have to tell you, I have one sort of economic souvenir in my office, and it's a signature of Milton Friedman. The argument that he was making is that comes from an earlier article called I Pencil that just said, there's no one person that makes a pencil or knows how to make a pencil. There are people who know how to grow and raise wood. There's people who know how to cut it. They know how to develop the paints. There are people who know how to stamp the brass holder for the rubber. The eraser is made somewhere else and processed in another country. The graphite's mined in one country and processed somewhere else. And then they come to 2 or 3 different factories in the same country. The parts are made and then put one place and assembled. And that in that process, there's no one human being who knows how to make a pencil, which is really made of 4 parts. 5 if you count the paint. Nothing like an automobile that's 30,000 component parts, or an airplane that's 300,000, or a washer and dryer that's 175 or 250 parts. So what Milton Friedman was suggesting is that if you interrupt the free trade of these things, you distort the prices of one element in this. And you do 2 things in a mistake there. The first one is you have the hubris to think that you know how to make a pencil, that you are clever enough to insert yourself into this very simple production process and determine where it's going to be made, who's going to be profited from that. And that's just it was absurd with something as trivial as a pencil. Terribly absurd in an integrated automobile market that spans across all of North America. And then the second part is that once you're fiddling with this, it gets broken in ways that you can't anticipate. And he's actually pulling that from an earlier argument by Friedrich von Hayek, that the curious task of the economist is to explain to folks that they know less about that they're trying to manage, which is a garbled quote about the real challenge is explaining to policymakers, you don't know how to do this. The people who know how to do this are doing this through this web of trade, this web of commerce. And when you insert yourself with it with something as damaging as a tariff or a non-tariff trade barrier, you're interrupting this beneficial exchange that makes you better off, it makes the sellers better off, and you're ultimately only have a very asymmetric negative effect on the welfare of the people you're trying to protect.
Okay, so let's talk about this pencil. And with these new tariffs, how does that impact the factory that has to make those pencils? Because they're getting those pieces, as you mentioned, from lots of different places.
Right. So the brass is probably being imported from a South American or African mine. So it's got roughly anywhere from a 10 to a 25% tariff on it. Most of the African and South American countries are 10%. The rubber is for the eraser is being harvested probably in Liberia. It's being harvested from rubber trees in a rubber plantation. Then it's being packaged and sent to a processing plant somewhere in South America or Canada or Mexico or the United States, most likely Mexico, where it's being processed and cut into rubber and fabricated. Then it's sent to a factory in the United States that is assembling the brass pieces that have been imported from somewhere else that somebody else has stamped into the right size. There's wood being cut from forests in Canada because they have the softwoods that you would use for a pencil. Again, the graphite is being mined somewhere. And so all of these now are being taxed somewhere between 10 and 25% if it's domestic in Canada. It's now, as of noon today, 104% if some of that graphite or brass is coming from China. And so the cost of that pencil, which would be, 15, 20 cents, after going through all of these supply chains, you're getting this pencil for just a stunning price. And which should shock you. You can just as a footnote, if you're an American, we don't have short pencils sitting around in our junk drawer. Our grandparents did, because a pencil was an extraordinary thing to own. Paper. I still have my grandmother's slate school packet because paper and pencils were so expensive. And today we give out pencils as Scooby snacks for people to sell our business. And so that process of trade has given us this great innovation to write with at pennies. And now we're doubling or tripling this. And the goal is either to, Mr. Trump has either suggested it's to eliminate barriers to trade, of which there were almost none on this pencil already, making that a dubious argument. Or the other argument is that it's going to reshore pencil manufacturing. So we have pencil manufacturers here in Indiana. Rush County has one of the bigger pencil manufacturers in America in it. But that's high-tech stuff, operating big equipment with well-paid workers who are processing this stuff and running through hundreds of pencils an hour, thousands of pencils an hour each. That's what we do really well. Somebody growing rubber trees in Liberia is going to be good at harvesting that. They're not going to have the education that our workers in Rushville have. And so if we substitute the centrally planned tariff economy for the free market, we're going to be worse off. And instead of importing pencils and brass and wood and graphite and rubber byproducts, we're going to be importing those jobs, which we don't want because they don't pay well, they don't support a living wage, much less a middle-class lifestyle. And that's really, I think, the ultimate challenge of all this.
So for an item even as simple as a pencil, it's not something that you can make fully American because the materials are not available in America. And then for the manufacturer, so let's say the one down in Rush County, to bring those materials now is costing them much more money than it did a week and a half ago.
Oh, absolutely. And it's double their cost, perhaps. To put in sort of context the magnitude of this, I've done some back-of-the-envelope numbers on the cost of trade. Talked a little bit about in the last episode. We're talking about like a $20 billion tax on Hoosiers a year of this. And most of that's going to be paid by manufacturers who are buying products to assemble into something that we're good at making. Some advanced manufacture process, as something like a pencil doesn't seem advanced manufacturing, but it's using a lot of high tech equipment all the way up through a knee joint or a shoulder joint or a hip joint, and then selling that in the free market. And the taxes on that now are 15% of the total value added that we're producing. So that's going to really hamper the demand for our goods and make it impossible for us to make these. So some of these things we just couldn't make here. We don't have workers that are willing to there's a reason why they're being made somewhere else. And so if we bring them back, we can't pay the workers a living wage. Otherwise, that product will be even more expensive than it would be with a tariff. And so there are no good options with this. There are very few places where that's going to work. I mean, there'll be a sporadic example of a small production line being reshored, but for the most part, we're talking about things being made in the vast world of imported and exported products that are better made somewhere else in the United States, who our workers are best for high-tech, high-productivity jobs that require 12 years of K through 12 education and a lot of infrastructure, reliable energy, and good transportation networks.
So I want to ask you a question and play devil's advocate a little bit, because there has been an argument made that the pencil factory, for example, if their costs increase, they should just eat those extra costs and not pass those along, essentially be making less profit. Can you just talk through the thinking of a manufacturer like that and why they would or would not do that?
Right. So there may be somebody who's just terribly wedded to the idea of tariffs that would forego profit to do that. Certainly a public company wouldn't do that. They're there and being tested on their maximizing profits. Most businesses are going to try to maximize their profit. And what keeps prices low is the discipline of imports and competition. So everybody I'd like to charge $5 a pencil. I could work for a few minutes each week, bear very few costs, make a lot of money. But if I do that, I'm not going to sell very many pencils. So the discipline of competition is the big factor in sustaining lower prices across the board in this. So if that's gone, you immediately have an open capacity for a firm to raise prices. And even if it were inclined not to do so, the fact is they're facing much higher. In the case of a pencil, tariff costs on it that would, maybe increase the price of their pencil by 50%, which is not a lot, from 17 to, 26% perhaps, or 30 cents. So, that wouldn't be a terrible price spike, but you're going to do that because your input costs are going up and there's less competition. So naturally, the prices are going to slowly creep up. And if you don't do it as a seller, if you're saying, well, I'm going to sell these to Walmart or I'm going to sell these to CVS, and this fall I'm going to keep my pencils just a little bit more expensive than last year. Well, that gives CVS or Walmart all the incentive to raise their prices on these, and they realize that, hey, it's hard to come by pencils because we're in the midst of a trade war, so I can charge a little bit more. Somebody in that supply chain is going to make that extra money, and the person who ultimately is going to pay is going to be that kid buying those pencils or that college student buying those pencils in August before they get back into the classroom.
So, there are arguments that some people make that say, well, these people who are participating in the economy, the pencil manufacturer or the retailer, they should, out of the goodness of their heart, not gouge people. Can you just talk about why, from an economics perspective, that actually would not be a good thing for consumers?
Right. There are several reasons why this would be a problem. There's a problem because the people who own this firm are, if it's a corporation, which most of these manufacturers are not privately held, they're owned by you and me, by stockholders, by pension funds, by the UAW pension fund, the Teachers Retirement Fund, by my TIA, CREF, Teachers Investment Fund. So if they don't make money, my retirement is a lot more sparse and farther away. And that's true for the currently 62% American households who own stocks and the 80 to 85% that ultimately will own stocks. So almost all American households now own some stocks over the course of their lifetime. Right. They just may not know it. They may think, oh, I'm getting my pension from the UAW. Well, it just went down 15% over the last week because of tariffs. So the pension fund for UAW is in real potential, long-term danger if we don't see a rebound in these stock prices. So people don't know that. So the idea that a company is separate from people is just fiction. The other sort of argument is that what prices serve as a signal for entering markets, and if you don't raise prices on those pencils, you certainly aren't going to get reshoring of it. You're just going to get fewer pencils because you're not profitable enough to keep the business going. Ultimately, the prices will go up or the businesses will fail. They won't be able to recapitalize. They're not going to be able to pay their workers, and workers are going to be very anxious to see pay increases in the coming years simply because the price of everything is going up by several percent this year without any shock to wages. So that's the flip side of this. It's not really inflation because inflation affects prices and wages. This only affects prices. So it's going to be far more onerous in the coming months and years. And so, at the end of the day, economists live by a very simple principle. We don't know what you want. We don't know what your tastes and preferences are. And we don't know what a business's cost structure necessarily is going to be. But we know that markets bring together the desire of people to own things and their ability to pay for them, that willingness and ability to pay, with businesses' desire to make money to sell things and their ability to do so profitably. If you're not profitable, you don't acquire the capital and the labor and the talent and the raw materials that you need. And so markets set prices that are best left outside of the control of government, unless there's some, long-term market failure like pollution that is affecting a third party. We don't want to interfere with that. And so when we gather taxes, we try to gather taxes in the most benign manner possible, a low sales tax on everybody, on every exchange, or a very low income tax on all types of incomes that are less distortionary. They don't change where people shop. They don't change what kind of business they do. Those those efficient taxes don't change behavior. They just get enough revenue to pay for schools and a police department and an Air Force. And so the tariffs don't meet any of those standards. They interfere by suggesting we're going to make decisions that products that are produced here are somehow merited over products that are produced overseas, even if they are pulled together to make the same thing. We're going to make them more costly if they're from overseas, and then we're going to charge. That's going to result in higher prices. And then we're also assuming that, in this process, government is deciding what types of things should and should not be made here, which is sort of the thing that the GOP has long rejected and labeled as socialism. And I think they're right in labeling that. Those sorts of decisions have not been successfully when made by central planners from the left. They're not going to be made any better by central planners from the right.
You mentioned the stock market and how a lot of people don't realize that they actually are invested in the stock market through their pension or retirement plans. Over the last few days, since the president announced this tariff plan, the stock market has had a lot of activity. I wonder if you can walk us through what we've seen and why.
Yeah. So the first thing to remember, the stock markets, the NASDAQ, the Standard & Poor's 500, the FTSE, this is the English stock market, the Dow Jones Industrial Average. These are indices, which mean they take the price of 100 or 500 firms and they look at them change over time. And the price of the stock really is a small slice of the ownership of that company. So that stock price reflects everything that everybody who might want to buy that company or sell that company knows about the future earnings of that company, how reliable things might be with it. And so soon after these tariffs were announced at 4 p.m. last Thursday, immediately after the stock market closed, we saw stock prices crash. They crashed by just under 5% on Friday. It was Wednesday they did. So Thursday they dropped by 5%. Friday they dropped by almost 5%. And then there are after hours tradings. They're called futures that predict what prices would be. And so as of opening on Monday morning, which would have been the third day, they were down over 4%, almost 5%. Had that price stayed throughout the day yesterday, those stock indices would have had their worst 3-day run since October of 1929, which most people will remember as the starting bell of the Great Depression. And so they recovered a little bit on Monday and they're almost unchanged as of last I looked on Tuesday afternoon. But the reason that they have done well is that there's a liquidity collapse. So there are a lot of sellers and not a lot of buyers. So if somebody buys one company's stock, there's a big swing in changes. So the volatility that we see is sort of an artificial residual that there are not buyers at lower prices out there. People aren't even willing to buy stock. So that gives us volatility. The fact that they were positive on Monday, probably negative on Tuesday, reflects a lot of rumors that have gone on about the potential for these tariffs to be ending. So the longer they go, we could have a day of green, a day of red. The longer we go, the longer the stock will continue to dip. On average, we're going to continue to lose. To put it in context, right now, over the past week, we've lost somewhere between 11 and 12 trillion dollars worth of value. That means investors, people who are very closely watching these stocks in big mutual funds, in big investment companies, think that American companies are worth $16 trillion less than they were last Wednesday at 3:30 in the afternoon. And that is solely because of the risks of tariff reducing trade enormously. And so why should you worry about that? Well, you should worry about it because the value of your retirement fund, the stock holdings, are now down substantially, depending on what type of stocks you had. Some people are going to be down 25%. Some people are going to be down 5%. It depends on what you're holding. And the other area to worry about is there's something called the wealth effect of this. And so Americans spend money based on, in part, they satisfy their basic needs, and then they judge how affluent they are, how wealthy are they. And if they're wealthy, if they're seeing their home price go up and their stock market portfolio go up and they're feeling comfortable and safe in their jobs, then the wealth effect says you're for every $100 that your wealth goes up, you should see about a 5% increase every 100% increase in your wealth, you should see about a 5% increase in your consumption. So you're seeing your stock market go up and everything is good. 5% of that $16 trillion loss is about $800 billion. And so
that's $800 billion less that people will spend in the economy.
So that's about 2.5 to 2.75% of our gross domestic product.
Meaning all the things that Americans produce.
Correct. So in other words, the size of our economy is about $27 trillion, $27.7 trillion last year. If we see a $800 billion reduction in spending by American households, boom, that's a recession. That's a recession in second quarter of 2025 right now that will last through the year. So just the stock market shocks that we've seen now, if they're perceived to be permanent, they're not coming back. And so households now have to close that 15% gap in what they've lost. That $16 trillion gap in household savings is gone. We're going to have to really work hard to get that back. So households are going to defer the spending on a boat or an RV or a car. They're going to skip a vacation. They're not going to go out to eat, twice a month. All those sorts of things are going to play into it. That immediately puts us into a business cycle that will fall hardest here in the Midwest because it's going to be initially manufactured goods that are feeling the pinch.
So you're saying that as the stock market goes down and people's portfolios then have a lower number in them, whether or not they're about to cash that out, they are feeling that loss, and it then makes them less likely to spend as much as they would have otherwise. That real loss of dollars entering the economy and buying goods and services has, again, also a real world impact on those businesses, those employees. And so they're going to invest less. They're not going to build that new factory. They're going to be laying off workers, which then I would think as you have more people who are losing their jobs, well, those people are going to be spending less as well. And is there sort of a flywheel effect that takes place there?
Yes. The issue is really that normally we would say, prices will drop. If there's less demand and I'm making RVs, I'm going to cut the price of an RV, so maybe I won't have to lay off as many people. And if the price of my services, I'm going to cut the cost of a vacation. I'm going to offer better deals. And that way you sort of preserve employment and the economy recovers in that way. These are called equilibrating forces. Well, the problem with the obstruction with trade, it moves the opposite direction. So now prices are going to go up. There's going to be less items available. Because there are less manufacturers, so prices are going to go in one direction, economic activity in the other direction, and that's stagflation. So we get higher prices, less economic activity, and so there's nothing to equilibrate or to move us back to recovery. And it also constrains the policy forces that would allow us to recover. So normally in a recession, the Federal Reserve will cut interest rates. So the economic shock like COVID that would make Americans afraid to buy RVs or new cars is partially mitigated by the fact that, well, gosh, now I could build a new home really cheaply. I can borrow that money to upgrade my car very cheaply because interest rates are super low. Those things are how we sort of stabilize these business downturns that we have. And there's nothing in the future of this economy that would suggest the Federal Reserve is going to have room to do that because prices will be going up. They'll be very reluctant to cut interest rates under a regime of higher prices that these tariffs have imposed. So it's really a downward spiral that goes for some time. My personal hunch is that will have been interrupted politically by January 2027, because that's when the next Congress will have met. And if we see the sort of economic expectations that I think that a sustained period of tariffs will generate, we're going to have a radical change in the composition of both the House and Senate in 2026.
But in the meantime, I mean, that's almost 2 years, and it sounds like a lot of damage can be done.
If we look back to the Great Depression experience, we could be double-digit unemployment rate by the summer of 2026, high single digits by fall of this year. So we're definitely moving very briskly into a downturn, and it's really contingent upon mitigating the effects of these tariffs. And I don't know, absent presidential action or Congress eliminating the 232 tariffs and having a veto-proof majority to do so, that's going to occur.
Okay. Well, on that happy note, we will close things for this episode. Dr. Hicks, thanks so much for joining me.
Good to be with you, Nathan.